and gentlemen, boys and girls, children 18 plus. You are tuned into the Loan Officer Podcast with me, Dustin Owen, and this dude.
Oh, JC. Good pause. That threw me off.
Threw me
off. The little hesitation.
Man, I'm fired up today.
Clearly.
Fired
What
up.
got you so fired up today, Dustin?
Life, man.
Okay, good.
Life.
Good.
Got lots of things going on. We're laying down episodes that hopefully when you're tuning in and listening to this, I'm sipping a Mai Tai
Yes?
and Waikiki.
What?
Let's hope.
Let's hope.
Let's hope. But the state of Hawaii, because we're still in a worldwide pandemic, they're very COVID safe. And in order to go to Hawaii, you have to actually pass a COVID test. Not one of those rapid tests, but like one of those tests where it takes 2-3 days to get your results. And then the results have to come back negative. You have to upload the results into a website, et cetera, et cetera. So I took a couple COVID tests yesterday. Kids took a couple COVID tests yesterday. We're hoping they come back in time because we have a Saturday morning flight to catch.
Okay.
And if they do, then we are going to reboot the spring break trip from last year.
Yeah, right.
This year. And it's a trip that I'm pretty sure I won in 2018 from work.
So this is literally 3 years in the making.
Yeah, like my two business partners and I at Waterstone Mortgage, we placed like number 1 or number 2 in the company overall. So that put us in a certain category where they gave out awards.
Okay.
And the award was like 3 days, 4 nights, first class air, luxury accommodations. Well, when I dug into it, it's basically a travel voucher. So I was like, okay, what's one place super far away from Florida that I probably wouldn't go to on my own? Hawaii.
And there we are.
Yeah, I mean, if half the trip's going to be paid for,
Let's do it.
you might as well go as far away from where you live
As possible.
as possible. Yeah, so I'm kind of jacked up about that.
Yeah.
I was venting about a car buying experience
Correct.
that I'm going to be polite. I'm going to give the dealership a couple days to rectify a situation that I thought was a little bit dirty, so we're not going to talk about it just yet.
Okay.
But we may be on full blast mode in a couple episodes. We'll see.
Okay.
We will see. It's a big learning experience, and it's every reason why we probably should do an episode again on buying a car.
Right? We should.
I mean, we did one way back in the day. Like, remember that? Like one of the first episodes we ever did.
Episode 6.
Was it really?
Something like that. But yeah, it was back then.
Yeah, we had Mike Williams on. Mike Williams at the time was a rookie loan officer. He's already turned into a top producer.
Right? That's crazy.
Like I think it was like number 4 in the entire state last month. But we had him on. It was kind of like during COVID. We're like, crap, we need a guest. Hey, Mike, come talk to us about buying a car. I thought I listened the whole time.
Too, buddy.
I thought I took down good notes, but obviously I didn't because I just had a not so
pleasant?
Pleasant's a good word. A not so pleasant buying experience.
Yeah.
So, yeah, what have you. But that's not what today's episode's about.
Oh, okay. I was wondering.
Nah, we're not going to go there yet.
Okay.
No, I promised. I said I'm going to give the dealership a couple days to rectify the situation.
Okay. So today's episode, what we're going to talk about?
What do you think?
I have an idea. It has to do with a viewer request.
Viewer request. We love, by the way, viewer or listener. Some people
Yep.
tune in on Spotify.
Correct.
Some people tune in on Apple.
Yep.
By the way, it's the Loan Officer Podcast, both on every podcast, Podbean,
Yep.
Spotify.
Everything.
Or you can watch us on YouTube.
Yep.
You can follow us on social.
Yep.
The Loan Officer Podcast.
Yep.
Instagram.
Yep.
Facebook.
Yep. LinkedIn.
LinkedIn.
Yep.
I'm Dustin Owen on LinkedIn. You are?
The Loan Officer Podcast.
You're John Coleman on LinkedIn, by the way, if you want to find him. He tries to like hide in incognito. And if you like what we're doing, which I'm loving this because more people seem to be liking it.
Yeah, right.
Either we're getting better or they're finally finding us, or probably a combination of both.
I would hope so.
But yeah, like us, share us, comment,
Please.
give us feedback, and more importantly, let us know what you want to hear.
Literally.
If it's something that we feel like we're subject matter experts on, we'll talk about it.
Yeah.
If it's something that we're not,
We'll find someone who is and bring them on the show.
or we will fail
Oh, yes. Oh, yeah.
hard
Yeah, that's what I'm saying.
forward
Yeah.
trying, as I've been doing, trying to find someone to come on to talk about NMLS, testing, the course, the pre-licensing, everything that goes along with obtaining your NMLS. I am not a subject matter expert.
Yeah.
I am desperately trying to find someone within a 50-mile radius of Winter Park, Florida, to come do a show with us. And you would think I was handing out like free packages of dirty diapers.
Here you go.
No one wants
No
them.
one wants
No one wants to be a part of this.
Well, you put it out in the universe, now you put it on wax, so I wouldn't be surprised in the coming days or weeks you land there.
But no, so this episode and maybe the next episode we do, let's just go ahead and let's zero in on viewer/listener request.
Okay.
Which this one came in via, I think, YouTube comment.
Yes, it was a
wasn't
YouTube
it? It was a
comment,
YouTube
yeah.
comment. A lady in Oregon.
Correct.
Wanted us to do something on home equity lines of credit, but John, she didn't call them that. What'd she call them?
HELOCs.
Confused the hell out of John Coleman, by the way.
I thought it was, I was like, oh, yeah, home equity line of credit. Another acronym.
Yeah.
Yes, I love it.
JC loves the acronyms that he gets to pick up working here at Waterstone Mortgage for the past 12, going on 13 months. All right. So let's talk about it.
Okay.
What are HELOCs? What does HELOC stand for? Is that the same as a second mortgage? Is that the same as a home equity loan?
Oh, yeah. That is a good question.
Do you know the answer?
No, but when you said
Okay.
it, I was like, I was like, a line of credit is like a second mortgage, but yeah, is it?
It's all of the above.
Okay.
It's all of the above. So we'll first start with HELOC.
Yes.
It stands for home equity line of credit.
Okay.
Okay, it's a line of credit based on the equity that someone has in their home.
Okay.
Okay, now some people are very fortunate and they don't have a mortgage at all. They literally paid their home off. Maybe they paid for it cash, maybe they got a mortgage, but they made payments until they no longer had payments to make. If that was the case, then you could go get a home equity line of credit on your home, at which point it would be the first mortgage because it's the only mortgage. First meaning what lien position is it in? Is it in the first lien position or the second lien position? A second mortgage doesn't mean, oh, this is the second time I've financed my home. Second means what lien position is it in?
When you say lien, explain that.
Well, a mortgage is a legal document that attaches your note, which is a promise to repay, to collateral, which is your home.
Okay.
All right. So a lien is just that. It's a third party telling everyone and their mother that the person who owns this home, in your case, John Coleman, you don't own it free. I have an ownership interest. I have a lien.
Gotcha.
Contractors put liens on homes all the time. Basically, it means I'm putting a lien on your house, which means you can't sell your house until you pay me off. So a contractor will place a contractor's lien on someone's home, do a bunch of work. Once the work has been completed, then they will take the lien off, assuming they got paid. If they didn't get paid, then the lien stays on.
Okay.
Okay, so that's a lien.
Gotcha.
You can have tax liens in life. That's bad. That means
Yeah.
you owe the IRS money.
Yeah.
Right? So they're somehow going to place a legal document against your future earnings stating that you cannot receive things like tax refunds until you pay the lien. Eventually, they could garnish your wages. That's a whole different episode.
Yeah.
That's not what we're doing here.
Okay.
HELOCs. Okay. So it stands for home equity line of credit. It can be a second mortgage. In most cases, it's a second mortgage, but don't think it can only be a second mortgage because we just talked about you could own your home free and clear, at which point all you have is a HELOC. Now, why someone would get a HELOC versus getting a new loan?
Yeah, why?
Well, that's a great question. Let's say you have a current mortgage, and your current mortgage is, I don't know, locked in at an awesome rate, 3%, 2.5%, what have you. And your home is probably worth 500 grand and maybe you only owe 250 grand.
Okay.
And maybe you have 13 or 15 years left on your mortgage. You do have an option of doing what's called a cash out refinance where you pay off that current mortgage, you get a new mortgage, and you can take X amount of dollars of equity out of your home. At which point you wouldn't need a home equity line of credit or a HELOC because you're just going to get a brand new mortgage.
Okay.
Okay. It's a refinance, but it's called a cash out refinance because we're not only going to pay off your current loan, but we're also going to give you money to do with what you want.
Gotcha.
Typically, in this market, especially, we do a lot of cash out refinances for debt consolidation. Hey, John, you owe $17,000 to American Express. You owe $9,000 to Visa. You have this truck payment at 9.77% interest. Plus, you owe the IRS $6,000 from last year's taxes. Plus, you want to remodel your 1988 bathroom. Okay, John, I have good news for you. Your home is worth $500. You owe $250. We can lend you $400,000 at a rate of 3.5, and we're going to pay off your current mortgage. We're going to pay off your Amex, pay off your Visa, pay off your truck, give you enough money to have your bathroom remodeled, which theoretically should increase the value of your home a little bit. And overall, we just lowered your monthly debts or monthly payments by $900 a month.
Awesome.
Yeah, that's a cash out refinance.
Yeah.
In some cases, it makes perfect sense to do a cash out refinance, at which point you would not need a HELOC. In other cases, it doesn't. What if John Coleman doesn't have a truck financed at 9.77%? What if your truck payment's at 1.9%? And what if you only have 20 months left on your truck? What if you don't have the Amex? What if you don't have the Visa? By the way, high five on all of that, right? Because you're doing it right. Like, you don't carry consumer debt. So you're like, yeah, you know what? My mortgage is at a great rate, and I only have 13 years left on it, and I don't really see myself wanting to start over on this mortgage, and I really only need 50 grand because what I'm trying to do is have a pool put in.
Okay.
Okay, well, let's go get you a HELOC or a second mortgage. And especially if you're like, plus, I'm going to have this thing paid down, maybe even paid off within like 12, 24, 36 months. Okay, cool. You can go to your bank or your credit union, and they'll look at your total scenario. They'll say, okay, well, where's your loan to value, meaning how much do you currently owe versus what your home is worth?
Right.
In your case, your loan to value, what's the acronym for that?
LTV.
LTV is 50, right? You only owe 250, but your home is worth 500. Your bank would gladly give you a $50,000 second mortgage or a $50,000 home equity line of credit for 50 grand, because now what's 250,000 plus 50,000?
300,000.
Yeah. So now combined, you only owe 300 on a home that we said was worth 500, meaning you have a boatload of equity still in your property. And a HELOC made more sense for you because in your mind, you and your wife are going to get this thing paid off in the next 20 months. And it's a line of credit. So here's what's cool about it. You get your bonus check. She gets her bonus check. You guys get it paid off in 10 months. Cool. Like, you only had to pay interest on it. You could pay as much or as little each month of principal as you decided, a lot like your credit card.
Okay.
And if you want to, you can keep that $50,000 home equity line of credit open with a zero balance on it. It's actually one of my financial advisor friends early on in my career, that was his advice to anybody who owned a home. Go get a home equity line of credit and open it. You don't have to use it, right? You can have a Discover card that you don't use. It's there for emergencies.
Okay.
Now, your 6 months reserve should be there for emergencies, but your home equity line of credit could very well just be there for emergency. Well, what's an emergency? I get an opportunity to buy a piece of land, but I need to close on it in 10 days. Can you think of a better way to raise $50,000 in 10 days?
Legally, no.
Yeah, right?
Yeah.
Legally, no. You know, and sometimes it's like, yeah, but I may have to liquidate some of my investments. Well, what if your investments are down 17% because we just had a massive sell-off on the NASDAQ and you're heavily invested in tech, which, by the way, just happened. Maybe you don't want to liquidate. Maybe you kind of want to give the market a chance to stabilize and possibly even rebound. Or maybe you don't want to liquidate certain investments because now you're going to have a tax liability. Okay, I can just go to my home equity line of credit. I can utilize my home equity line of credit to purchase a boat, purchase a truck, do home improvements. Like, there's various things that you can do. Now, it's a mortgage. So assuming in your case you have a first mortgage, this is now going to be your second mortgage. It's called a home equity line of credit. But the line of credit aspect is what makes it unique. The fact that you can pay it down, you can rack it back up, pay it down, rack it back up, just like a credit card, but you're using your home's equity as collateral, which lets you borrow at much cheaper rates than you could on your credit card. Like, if you have great credit right now, I'm guessing a credit card somewhere between 7.99 and 9.99%.
Yeah.
That's my guess. A home equity line of credit, your rate could be 4.5.
You said you could add to it, like you could build it back up. Is that like going back, you have to apply again to like get more money into it?
It's like your credit card. If you have a credit card right now with American Express and it has a $20,000 limit, but you only have $5,000 currently charged on it, how much do you have left to go spend? You have 15 grand left. Your home equity line of credit works the same way. If you owe zero, you pay zero. If you have a $50,000 line of credit, but you only use 45, you have $5 grand left. And then, so, in the example of the person wants to buy a pool, Maybe they do want to buy a pool, but the pool is only $45,000, but they realized, man, I'm missing some landscaping.
Yeah.
I had this beautiful pool, but my landscaping is kind of subpar. Cool. Why don't you use that $5,000 for landscaping if you would like? Or you could use the cash that you have in your checking and savings, or you could go liquidate some of your investments, or you could use your line of credit because you love other people's money.
Yeah.
If you leverage yourself properly, like I was talking about my car buying experience, the reason why my wife and I chose to finance the car is because we got an interest rate below 2%. That's amazing. Why would I want to go and A, liquidate some of my investments, which is going to create a tax liability for me, but B, pull my investments out of the market when the market is doing so well right now and I'm only paying 1.9 on my car? No, like I want to make the difference between the 1.9 I'm spending and what I'm earning. I looked at the interest I would pay over the next 60 months. The interest I would pay over the next 60 months, 5 years, is less than what I'm going to earn in the market this year on that same dollar. So people will utilize their home equity lines of credit for just that because it allows you to not have to touch your current mortgage. Now, you may want to touch your current mortgage, right? There's a good chance your current mortgage is at 4.5% because you bought your home 5 years ago. And rates today have been between 2.75 and 3.25 or 3.5. And you're like, wait a minute, I can kill 3 birds with one stone. I can lower my rate, I can pull cash out, lower my payment, pay off some debt, whatever the case may be. And we're doing cash out refinances. But, you know, look, we've done cash out refinances where someone's rate went up. I mean, I changed a person's life because he only owed $130 on a home that was worth $430. He had so much consumer debt, he was never going to make enough money to pull himself out of it. We took him from a 3.5% rate to a 4.5% rate and changed his life because it wasn't about his mortgage. It was about his total financial picture. We saved this dude $1,400 a month.
Damn.
You know what we also did? Saved his marriage.
Saved his life.
Yeah, well,
Kind of.
yeah. Definitely his marriage, right? That extra $1,400 was every reason why he and his wife fought because they were paycheck to paycheck. Didn't know they were robbing Peter to pay Paul. Well, let's pull money out of this account to pay this card and, you know, constantly playing the shell game. So, yeah, that's a little bit of off topic. I want to stick onto the home equity line of credit. And by the way, you can do what's called a home equity loan. The difference between a home equity loan and a home equity line of credit, typically, a home equity loan is closed end, meaning John goes to the bank gives him $50,000, and they say, John, you owe us back this $50,000 over the next 10 years at this payment. As you pay down your home equity loan, you can't go and draw more money off of it.
Okay.
So the line of credit, it operates just like a credit card.
So when you like HELOC, do you have to pay that like monthly or something?
Yes. Yep. And typically it's an interest-only payment just like your credit card is. So someone could, and I don't advise this, they could borrow $50,000 and only make a payment of like $90 a month, whatever their interest is. But ideally, depending on your situation, right? I guess I can make an argument for the person that's like, no, I'm just going to pay interest because maybe that person's expecting a big cash windfall. And once they get that cash windfall, then they're going to pay it off. So to them, they may utilize a home equity line of credit in order to free up some of their nest egg, right? You think about it. Most people, their wealth is tied into their home. Their biggest asset is their home. So they don't have money sitting in a JP Morgan investment account or a McCoy Federal Credit Union account. No, their money's tied up into their home. This home equity line of credit would allow them to access that money, use it. So like a good example would be, I don't know, my grandparents passed away. Their home is in probate. I know when the home sells that my portion of the estate is going to give me $35,000. I don't want to wait the 9 months for this thing to go through probate, and there's something I want to do now. Okay, cool. Maybe I'd go utilize a home equity line of credit because I have the equity in my home. I have a good job. I have good credit. So my bank lends me $35,000. They utilize my home's equity as collateral, and I just make the simple interest payments for the next 9 months because I know as soon as Granny and Pop-Up's home sells, I'm going to get my $35,000 and I'll pay off the home equity line of credit.
Do people have do they take out a HELOC and then take all that money and just like put it in the market? Could you do that? Like, hey,
I think that's illegal.
Okay.
I'm not a financial advisor.
Yeah.
I play one on TV, John.
Yeah.
I'm pretty positive that's a big no-no.
Okay.
Yeah. But how about this? I want to buy a lake house.
Okay.
I want to buy a place on the river. I want to buy a place at the beach. I need 20% down. I need 10% down. If I pulled it out of my savings and checking account, it's going to drain everything. I really don't want to pull it out of my 401k because my 401k has been kicking butt and taking names. And I don't want to take it out of my mutual funds because I don't want to create a tax liability. But I'm sitting here looking at my current house and I have a crap load of equity. Like, again, this home's worth $500. I owe like $200.
Mm-hmm.
The condo I want to buy is $400,000. I would like to put 20% down, which would be $80,000. But I'm going to need closing costs and some of this furniture has to go. Like,
Yeah.
I'm going to have to paint the walls
Yeah.
and so I need $100,000.
Okay.
Okay. Why not go to your local bank or credit union, take out a $100,000 home equity line of credit, use that $100,000 for your 20% down for your closing cost and to pick up some new decor for that beach condo. Now, for some people, that's not going to make sense, right? This is not a one-size-fits-all. Nothing ever is.
Yeah.
For some people, they're going to utilize a cash-out refinance for that, right? But for the person who, I love my mortgage, I love my rate, I don't want to touch it, and I have, but I want access to some of my net worth, but I don't want to touch the things I mentioned, checking and savings, I don't want to touch the 401k, and I don't want to touch the mutual funds. All I'm doing is I'm transferring equity from one property to the other. That's all it is. And now I have a payment of $100,000 on $100,000 at a super cheap interest rate because interest rates are super cheap.
If you get a HELOC and you don't pay it, can that hurt your credit score?
Yes.
Okay.
Yes. Anyone listening, not paying your bills hurts your credit score. I don't care what it is.
Okay.
Yeah. I mean, I guess not paying your mom back
Yeah.
doesn't really hurt your credit score.
So HELOC, that's interesting. I never really thought of it like that.
Yeah. So that's HELOC and home equity loan they're pretty similar. Just one acts as a line of credit. A loan is a loan, meaning that's all you're going to borrow, and you typically don't have the opportunity to do a interest only payment the way you do on a home equity line of credit or HELOC. On a loan, you're going to have an amortized payment, meaning your payment is principal and interest.
Yeah.
And they're all synonymous for second mortgages. Something else that you could use a HELOC for. Let's look at today's housing market. Today's housing market is very competitive, extremely competitive. You as a seller know there's going to be no issue selling your house. You're going to sell it. You're going to have multiple offers. You're going to get top dollar, high five. But if you're trying to buy a house, you are one of multiple people trying to buy that house that are interested. So you want to make your offer as strong as possible. Well, think about yourself, John. If you and your wife wanted to sell your home and buy another one, in a perfect world, you would sell first and then buy, even if you sold at 9 a.m. and you bought at noon. You don't really want to have to carry two payments, nor do you maybe have the funds for the new home purchase until you sell your current house. But it's so competitive out there that sellers are going to laugh you off the block if you try to make your offer contingent upon you selling your house. Okay, well, how about this? Before you put your house on the market, because by the way, there's a reason why I'm saying before you put your house on the market. I say that because a lot of banks that I know of, they won't lend you if your home is listed for sale. Now, if they lend to you and then you list your home for sale, there's not a whole lot they can do about it. But if they see your home is for sale, they're not going to lend to you. Unless you get what's called a bridge loan, and I'll cover that briefly once I'm done with this example of how you can utilize a home equity line of credit. Okay. So, John, in your case, you go ahead and you plan things out. You go to your bank, you get a home equity line of credit. So then now you know you have X amount of dollars freed up on a line of credit utilizing the equity in your current home that you now can use to purchase your next house, whether it's $50,000 or $100,000 or $200,000. You and your wife have opened a line of credit utilizing the collateral. Now, when you go to make an offer, your offer is not contingent upon you selling your house. Now, with your lender, like if you're talking to Kevin Murphy at Waterstone Mortgage, Kevin's going to have to make sure, do John and his wife, do the Colemans qualify carrying their current home, this new HELOC payment plus the new house payment?
That's a lot.
It's a lot, yeah. But you and your realtor are gonna get your house sold in record time.
Yeah.
So you're not as worried in today's market about having to carry 2 payments, but you still have to qualify for the what ifs a factor. But by you getting a home equity line of credit or a HELOC prior to you listing your home on the market, you've now freed up that $50,000 or that $100,000 that you're going to need to go make an offer on the new home. And now when you make it, you're making it not contingent upon you selling your house because you've already tapped into the equity. And now you can put your 10 or your 20% down. You buy your house, and then the same day that you just make your offer non-contingent, and you probably go ahead and put a sign in your yard the minute that you get a home under contract, right? Or you get a home under contract, you do your appraisal, you do your home inspection, your lender does the initial underwrite, and you feel really good. Hey, we've passed inspection, we've passed appraisal, and my lender's already approved my loan, even if it's with a couple minor conditions.
Yep.
At that point, you put your house on the market.
Gotcha.
Yeah, so that's how people are utilizing, or they can use, home equity lines of credit. Yes.
What happens if you don't pay your HELOC and you just take all the money out and you just never pay it? Do they come and take your house?
Yeah, they'll foreclose on your home. Yes, it is a mortgage. Yes. Anytime that you're utilizing your home or your home's equity as collateral, there will be a mortgage. That's why we call it a second mortgage. Yeah, my parents were like, "Oh my God, all the dental work we spent on you and your sister, we had to get a second mortgage."
Okay.
And it never dawned on me as a kid, like, what are you talking about?
Yeah.
Now it makes sense.
Okay.
Right? My parents probably bought their house for $50,000, and they probably, by the time I needed all my dental work, they owed $30,000. The house was probably worth $90,000, and my dental work was $20,000. So they went and they obtained some kind of a home equity line of credit or home equity loan, and it was a second mortgage because they still had their first mortgage. And this is just a second mortgage, so now they have 2 mortgage payments.
Are individuals that are like really financially savvy, got a lot of money, know what they're doing? Do they use HELOCs? Is like HELOC is something used by
OPM.
Other
people's
people's
money. If you can use other people's money, that's how you leverage yourself to build wealth. Yeah, OPM. If it makes sense, like OPM. Why did Dustin and Michelle Owen finance their car purchase? Because OPM. Because I'm only paying 1.9%, and I'm earning 8 to 12%. Why would I ever want to take money out of a vehicle that earns me 8 to 12 in order to save 1.9? I mean, that's like kindergarten math.
Yeah.
That's assuming you can qualify. This is why it's so imperative that young folks understand the power of credit and a credit score, and why it's so important to have credit, use credit, but do so responsibly so that you have a high credit rating.
Gotcha.
Because you can't do some of this stuff if you have crappy credit.
That's what I say. So let's say you have terrible credit, but your house is paid off. Will that limit how much?
No. The answer is no. You lost me and I had bad credit. Common sense would say yes, right?
Yeah.
Why wouldn't I? But things don't work utilizing common sense. There's still going to be certain parameters, certain bumpers that we're going to have to keep.
Yeah.
Keep it between the lines. And yes, you could own your $1 million house outright, but if you have no job and a bankruptcy yesterday and a foreclosure 2 years ago and terrible credit, I would personally.
Yeah.
I would love to give you $100,000 and slap a mortgage on it, and I pray to God that you that you foreclose on it.
Yeah.
Yeah, I'll pay those attorney's fees. I'll go through that hassle. But no. Yeah, and that's probably something key to know. So good question actually is, understand you're getting a second mortgage. There is a certain risk that the bank or credit union is taking on. The first risk is that they're not even in the first position, meaning when and if the crap hits the fan, your first mortgage lender gets paid before they get paid. So that's why it's going to be more difficult to qualify. They're going to have higher credit standards. For example, we can do a loan for you. Any lender in America can do a loan for you with a 620 credit score, but you might not be able to do a HELOC with less than a 680. We will do a first mortgage for you with putting 3% down. Hell, if you're a veteran, you can put 0% down. If you're buying in a rural area and you qualify for USDA financing, 0% down. Oh, wait a minute. It's a second mortgage? I'm only lending to 90% combined loan to value, meaning when I add what you currently owe with what I'm going to give you, and I divide that by what your home is worth, I need to make sure you have 10% equity in your property. So it's definitely something that is a luxury financing vehicle. It's a lot easier to qualify for a first mortgage or a primary mortgage, and even a purchase, like when you're purchasing a home. So getting a HELOC on a second home, an investment property, or a condo would definitely be more difficult than when you obtained your first mortgage.
Gotcha. Do you when you talk about, because a HELOC is tied to the value of your home, is do you need like your house to get appraised? Like you need someone to come appraisal come in?
Yeah, they'll do some form of appraisal, whether it's a drive-by or what they call an AVM, which is automated valuation model, basically Zillow, right?
Okay,
They don't use Zillow. They use something that's a little bit more astute and proven than the Zillow algorithm, but essentially that's what an AVM is.
Okay.
They could require, each bank and lender is going to have their own requirements.
Gotcha.
They could require that a full appraisal is done.
Okay.
Yeah, all depending on the scope. I think that's where the levels of risk come into play. Like at a 90% combined loan to value, maybe it's a full appraisal. But at a 60% combined loan to value, meaning when I combine what you currently owe or owe and what I'm giving you, and that combined is only 60% of what your home is worth, maybe I'm totally cool using the AVM. But there is a credit qualify. And because it's a mortgage, certain states are going to have their same applicable document stamps or title fees that go along with it, but they're usually nominal.
Can you take out multiple HELOCs? Can you have like 4 HELOCs at once, or just like one?
I wouldn't think so, no, because every time you get a new loan, that would go in the third position, the fourth position, the fifth position. What you would do is you would increase your equity line, or you would get a new one that would pay off the current one and give you new terms.
Okay, gotcha.
Is what you end up doing. Now, you can have a first mortgage, you can have a HELOC, and then 2 years down the road, let's say 2022, mortgage rates drop again, which, by the way, that could very well happen.
Yeah.
At that point, you could go and get a brand new mortgage where you pay off the old first mortgage, you pay off the HELOC, and now you just have one loan again.
Damn, there's so many. Damn.
Yeah, and these are things that, honestly, these are thoughts people should be having when they're buying their home. So I spoke briefly on bridge loans.
Yeah.
Full disclosure, I've never seen a bridge loan actually work.
Never heard of one until today.
Okay, they've been teaching bridge loans for 20 or 30 years. I described a workaround to the bridge loan. A bridge loan is for somebody who is selling their house in Connecticut, they're buying their home in Florida. The home in Connecticut is on the market, but because it's Connecticut, it's still freezing cold, and home buyers have not snuck outdoors to start looking at homes. They have a crap load of equity in that home. I'm talking that home is worth $700 and they only owe $150 on it. And it's on the market. But they want to buy this house here in Florida for $500 and they want to put $200,000 down, but they don't have that $200,000. A bridge loan is something that is used solely to utilize the future proceeds from when they do sell the home in Connecticut to make the purchase in Florida. I've never come across a bank or a lender that actually does bridge loans. That's why we came up with the workaround. Hey, before you put your home on the market, then go ahead and get out a home equity line of credit. I use this. I had a client call in. Gosh, I was covering for Kevin. He and his wife were up in Asheville, North Carolina on vacation. And I love covering for Kevin because this is like the 2 or 3 times a year that I get to be an LO again.
Get your fingers ready.
Yeah, like don't get me wrong. At home, like I start complaining to my wife about it. Oh my God, this week is gonna suck. I got to do all of my work plus cover for him. But it makes me a better person. It keeps me in the groove.
Yeah.
And so I was fielding phone calls and working with Kevin's loan partner, and together we were going to cover for him while he was out. And someone was like, yeah, hey Dustin, here's what we're going to do. We're going to sell our home in North Carolina, and then we're going to pay it off. Pay what off? I'm like, pay off the home in Florida? He's like, yes. Okay, I don't want to do a mortgage for you.
Really?
I don't need to do a mortgage for you. Like, why do you want to go through the rigmarole of paying $900 to $1,300 in lender fees, plus appraisals, plus all the various state tax stamps, and because Florida is a fairly high closing cost state, plus the additional title company charges, and the process. What I realized with these people is they had about $100,000 cash. They're buying this home for like $390 or something. They had $100,000 cash. They owned their home free and clear. And it wasn't North Carolina, it wasn't Connecticut, but actually it was Pennsylvania.
Okay. In
Pennsylvania, I said, cool. Call your banker. Go to Happy Valley Bank. Get a $200,000 home equity line of credit. It'll probably only cost you a few $100 or $1,000 in total closing costs. Use that $200,000 plus the money that you have saved already, and make yourself a cash buyer in Florida. I already talked about what a competitive real estate market it was. You want to stand out, be a cash buyer. And they're like, what do you mean cash? I go, well, you're going to leverage the equity, because all they were going to do the other way was have me do a loan for them, and then in 60 or 90 days pay me off. But they were going to go through paying all these closing costs plus a pretty strenuous process. I'm like, no. Look, I would love to do a loan for you. That's how we get paid. That's how we make money.
But that's what you're saying. That goes back to all the stuff we talk about, like just being a knowledgeable, good loan officer. You could have been like, yep, sure, I'll do the loan for you, but you do it.
Yeah, maybe it'll help me go to a President's Club. If I go to a President's Club, I get a free trip to Costa Rica. Nah, that's not what I would do for me. Like if it was me in that situation. So those people were utilizing a home equity line of credit for that. But they could have utilized a bridge loan. If you ever hear bridge loan, just know that if you're tuned in, Dio says they don't exist. I'm sure they do, but there's like a couple things that you hear growing up. Whether you're growing up into the industry or growing up as a person, like teens to 20s to 30s, bridge loans and like seller financing and rent to own. I'm like, yeah, no, those are unicorns and Lucky Charms. Like they don't really exist. Yeah, but there is such a thing called a bridge loan. I'm sure there's a lender somewhere in the United States who actually does them and does them well. I say, look, if you can't find a bridge loan, then work it the way I told you. Go get a home equity line of credit or a HELOC on your current home that has all the equity before you have it on the market. Then leverage that HELOC for the purchase of your new home. And then obviously when you sell your old home, you will pay off the HELOC.
Damn.
Bridge loan works very similar. And a home equity loan is basically the same thing as a HELOC, but it's not. And it's not because there is a cap and there is a payment schedule that differs than a HELOC.
Damn, that's deep.
Second mortgage, 101. HELOC, 101. Do we cover all the bases?
I think so.
One last food for thought. If we have any consumers who made it this far listening, I don't know many independent mortgage bankers, which is what companies like Waterstone is, or Guaranteed Rate or Prime or Movement, or God, there's a plethora, Fairway. I don't know that many of us that do HELOCs well or do them at all.
So, but we offer it as a product? Like
we don't.
Okay.
We don't. If Doug Gordon's listening, Doug Gordon's the president of the bank that owns Waterstone Mortgage. Hey, Doug, I think the field would love, wink, wink, nod, nod, would love to be able to originate HELOCs, but no, we don't, and most others don't. That's why you heard me reference throughout the entire show. Go to your bank, go to a credit union. It's somewhere between getting a mortgage and getting a credit card. It's not as easy as a credit card, but it's not as hard as getting a first mortgage.
That's a good way to put it.
Assuming you qualify, but do understand that there's definitely some more restrictions put on qualifying. It is going to have higher FICO requirements than when you purchase a home outright. And then lastly, I had one more here it is.
Okay.
Look at that. Let me take a sip of my water real quick, though.
I'm glad that reminded you. Because you were going to look at me and I was going to look at you blank like I have no idea what you're about to say.
Beautiful brown eyes I was staring into. They were my muse. No, here's a super creative way you can utilize a second mortgage to actually purchase a home.
Okay.
So please know, and that's, a whole nother topic of conversation. We talked the whole day about HELOCs for a home that you already own. You can actually utilize some kind of a second mortgage. It could be a HELOC. It could be a closed-end second. Closed-end second would be that home equity loan where, let's say you're buying a home for $700,000, but you and your lender have determined that, man, you can lock in a really good interest rate on a conventional loan for 30 years, but a conventional loan only allows you to finance somewhere around $530,000 or $550,000. They keep on increasing. Man, it was $417 when I got in the business. Actually, it was like $383 when I got in the business. Then it went to $417 and it stayed at $417. And off the top of my head, I'm showing a little bit of my old age. I honestly, right now, today, this afternoon, I cannot remember if it's $530 or $550. Let's call it $550.
Okay.
So if you're buying a home for $700,000 and you want to get that really good, cheap interest rate fixed in for 30 years, but the best way to get that is on a conventional loan, and the maximum loan amount is $550. And you don't have the difference between 700 and 550 to put down, right? The difference between 700 and 550 is $150,000.
$250. Oh, yeah.
250.
You said 750. I'm bad at math. Yes, agreed.
Agreed.
Yeah.
You're financing 550. The home purchase. Here. Let's just do 800.
Okay.
Let's do 800.
Yeah,
we're really gonna stretch. So at $800,000, you don't have that. Do we do 800 or 700? Let's go back. I'm so sorry, guys. I'm getting all confused. I don't have my HP 12C right here. It's late in the afternoon. If you're borrowing 550 plus 150 equals 700,000.
Yes.
But you don't have $150,000 to put down. You may only have $70,000 or $80,000 to put down.
Yeah.
What you could do is a combo loan. You could put down your 70 or your 80 grand. You could then get a second mortgage for the other 70 or 80 grand. And then you could lock in that super cheap interest rate for 30 years at 550. So it's a combo loan. We did them a ton back in the early 2000s.
I did this.
Right, we would call it an 80-10-10. You have an 80% first mortgage, a 10% second mortgage, and you put 10% down.
I've actually heard of that.
Yep.
80-10-10, okay.
Yep. So yeah, that is also a way, and it's called a purchase money second. So that's just a food for thought. Something I think good to end the show on. Something to make you say, but something we don't have enough time to dig and dive deep into.
Well played.
What do you think, John? Did we do a good enough job of HELOCs?
Yeah, because I learned a lot today.
If you learned, then I know they learned, honestly.
I'm serious, yeah.
Cool. Ladies and gentlemen, thank you for tuning in. He's John Coleman. I'm Dustin Owen. You've tuned in the Loan Officer Podcast. If you want more, check us out.
Yes, sir.
Spotify.
Yes.
Apple Podcast.
Yes.
YouTube, LinkedIn, Facebook, Instagram, at the Loan Officer Podcast. If you want a particular show done,
Write us a message.
write us a message. Reach out to us. Let us know.
Yep.
We'd love to hear from you. But that's all we have for today. Take care and
Peace.